Hello everyone, welcome to this week's market analysis session. My name is Carl Capolingua. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we delve into all of the key events on markets last week and have a look to the week ahead. Let's kick off with a quick recap of crypto markets for the week. It wasn't a great week for crypto, but having said that, we have seen a little bit of a bounce over the last sort of 12 hours in the likes of Bitcoin. It's now trading back over 30,000. So I'm going to say that's probably about flat for the week. Ethereum still, I think, eking out a small loss, and the others falling away from there. Regardless of how good or how bad this week has been, you can see the monthly declines are horrific, and poor old Luna down the bottom there with 100% monthly decline, now trading at 0 with a bunch of decimal points and then a number from there. In terms of the overall crypto market fear greed index, we have slipped to 10, but that doesn't really take into account the rally we've had in the last 12 hours, and maybe just overshooting, and we're probably more like 14, which was yesterday's reading. But either way, it doesn't paint a fantastic picture for confidence in crypto at the moment. And really, if a picture could tell 1,000 words, it would be this chart with the cryptocurrency total market cap falling from about 3 trillion back in early November to about 1.25, 1.3 at the moment. So that's somewhere around about a 58% decline in the total market capitalization. We're going to find that because this chart is largely influenced by Bitcoin and Ethereum, the next two charts are going to look pretty similar. But I'm going to take some encouragement here from this candle on Bitcoin. We talked about it last week, this idea that it represents a changing of the guard. So obviously we know prices were heading down into that candle. There was a lot of deleveraging. There was a great deal of selling as a result of that Luna crisis. But the reason why I call it a changing of the guard is we look at the volume. Volume is buying and selling, don't forget. So that selling was being met by buying, albeit people looking to take a stand or take a position at a much lower price. Once that supply evaporated, really, there was only demand of the system. We haven't seen a tremendous rally from there. It's quite customary for volume to come back. If we do see a rally, we haven't seen it. So I would suggest there is still a little bit of a buyer's strike on Bitcoin at higher prices. Certainly it's well supported under 30,000, but we need that psychology to transition to fear of missing out. So the opportunity below 30 has evaporated, and now we are going to have to pay higher and higher prices. Until I see that, I can't get bullish on Bitcoin. I wish I could tell you otherwise. Really, I'd be looking for a close above this 34,329 handle, I think is important, and maybe even the psychology of 35. So close above that before we can start to say that the short-term Bitcoin trend, at the very least, is changing. Long-term trend won't change until we're closing above this dark pink zone here around about 42,000. Having a look at Ethereum, just going to call detail on this one very quickly. I'd need to see it get above this 24.45 and probably even 2,500 before we can say the short-term trend has changed, and it won't be until a close above 3,000 until we say the long-term trend has changed. Bringing it back to Aussie shares now, S&P ASX 200 up 1% for the week, a nice gain, all things considered, paring back some of those monthly losses. Having a look within the sectors, gold, the clear standout, but really just bouncing off a pretty nasty performance over the last few weeks. Before that, you can see for the month, it's still down 14.5%. Technology, pretty similar story there. Another bounce, still down 14% for the week and 20% year on year. Materials, another nice bounce there, 3.65%. Utilities, I think, is the highlight because, yes, it's up 3.5%, but it's still actually got a monthly gain there and certainly a very nice yearly gain there. In fact, outperforming all of the other sectors on a yearly basis. And to be fair, I still think the chart looks fantastic. They do sort of fall away in terms of interest from there, so maybe we'll keep going. We'll head over to the ASX 200 chart now. A couple of interesting factors here. Certainly this white candle is very interesting. We can see the size of the white candle eclipsing the very bearish black candle before it. And you might say, hey, Carl, that's just ebb and flow of the market. It doesn't mean anything. You got white, black, white, black. It is actually quite meaningful because the way I look at this black candle here, so it's this one here that the low was 69.30. At that point, the technical picture is looking pretty terrible. So what it does is it brings a lot of short sellers into the market, expecting that the price is going to go lower, and it takes a lot of people out of the market. So people panicking out, looking at that chart going, geez, I think the market's going to go low and I need to go to cash. So we get a buildup of cash and we get a buildup of shorts. But this white candle, for whatever reason it occurs, catches all of those bearish people off guard. So the people in cash start thinking, well, maybe I got it wrong. Maybe I need to get that cash back to work. Where would I like to do that? Well, I'd like to see the price come back first before I do that so I can get back in as close to where I got out. The shorts, they're thinking, well, I'm in a loss now. And I need to try and minimize that loss. So if we see the price come back and then we see another cluster of white candles or lower shadows somewhere around this 7,000 handle, then that would indicate that we're moving back into more of a buy the dip pattern, or at least cover our shorts pattern. Would be very interesting. I'm not sure if that was enough on Friday. I think it's a great start, but I'd like to see some follow through today, tomorrow, and through the week. Ideally, we even see a close above this 72.33. I think that's a key zone now. And if we can close above that, I would say that the short-term trend is changing back to up, and then let's tackle the long-term trend from there. So I'm going to say it's a pretty crucial week. Hey, if we fail, if something really terrible happens in the US, and we crack 69.30, then again, we are back into this more transitioning into this bear market phase, but potentially a stay of execution with Friday's price action. 67.58 beneath that, it's unequivocal we are in a bear market. Having a look at the overseas markets now, pretty strong performance across the region there. Not a strong performance in the US. You can see down between 2 and 3%. Got some reasons for that later on as well. And look at those monthly declines now. They're looking pretty awful and down on a year-on-year basis. Pretty rare you see that. European markets also softer. Volatility holding at uncomfortable levels, but at least it didn't spike too much higher on the back of some of these bearish moves. Having a look at the S&P 500 index at the lows, at that low there, we were in bear market territory. So if you go from 48.19, that high, down to this low, I think the total decline was about 21.9%. And that 38.54 is 20% off that high. And 20% off the market highs when we say we're in a bear market. So very interesting to see us almost get there last time before we saw a bit of a plunge protection team intervention. And we saw another plunge protection team intervention around that level. What is the plunge protection team? Well, I'll let you Google that, but it's a bit of a conspiracy theory. The proponents of US capitalism and US bull markets are part of that. They tend to come out those crucial levels and throw a little bit of money at the market when it's the most vulnerable to try and turn it around. But again, Google that for the conspiracy theories. Plunge protection team working also on the NASDAQ on Friday night, avoiding a close beneath this low and then just a continuation of this terrible downtrend. This chart doesn't look fantastic. Established short-term downtrends, well-established long-term downtrend now. Price action still looks terrible. But when you see candles like this, you do sort of get the feeling that there is a little bit of bottom fishing going on, and it could turn into something a little bit more interesting. However, I would suggest until we close above 12,203, maybe even 12,555, that breakdown there, I wouldn't be getting too excited about a sustainable rally in the NASDAQ. Really, it's still potentially going to reverse back off this light pink zone and just come down and make a new low. That's the most likely scenario when the trends are so well established to the downside. And I couldn't be even contemplating a move back into a long-term trend or a new NASDAQ bull market until we're closing above this long-term downtrend zone here, which as it falls, that's probably going to be like a 13.5 or a 13.8 even back to the upside. Having a look at some of those industrial metals now, they had a great week. Look at that, aluminium up 6%, zinc up 6%. The most important ones for us locally, of course, iron ore getting a little bit of a rally there, up 2.6% in Singapore. That's the chart on screen. I like this candle from Wednesday. I love this candle from Thursday. Friday, a little bit indeterminate, but otherwise we're seeing a bit of a push off this 120 level. So that is encouraging. I'm not saying we're necessarily out of the woods just yet. I'd love to see a close back above 140 before I can start to really entertain a reversal of this short-term downtrend. Otherwise, copper up 3%. We've got a chart of that coming up next. That's important for us, and nickel getting a 2% gain as well. Gold bouncing back nearly 2%, silver about 3%. Having a look at the copper chart, I can see a nice little inverted head and shoulders here. So that's the shoulder, the first shoulder, then we've got the head, and then we've got the second shoulder, and it's called inverted, of course, because imagine somebody standing on their head. What's positive about this particular inverted head and shoulders is we've got this upward sloping neckline, and that's usually considered to be quite a bullish indicator as well. Well, as bullish as that might be, the overall picture is still quite bearish. So we can see short-term downtrend, we can see the long-term trend is changing, and it will probably resist prices in this zone. Okay, so the key now is what we do in here. If we get in here and we start to make higher troughs and higher peaks, okay, we're going to keep going. That's fine. If we get in here and we start to see maybe even an actual head and shoulders pattern, so sort of peak, head, peak, coming back down, then this is now dynamic resistance okay? And we probably will see a broader sell-off. So great that there's a rally, but also great that we're going to get a pretty good indication of where we're going next pretty soon as well. Having a look at nickel, bouncing off this long-term dynamic support zone. No surprise there, we did tip that in previous analysis sessions. Having a look at this support zone, you can see just how predictive it has been and how reliable it has been as finding those points where the nickel market has turned around. And there's no real reason for that to be the case. So these are my own custom indicators. I just find that they're the ones that work best in finding that dynamic support, okay? So it's not, don't look at my charts and say, well, that's where the price has to turn around. It's just my analysis suggesting that that's where it's most likely to turn around, okay? Case in point, didn't really happen here on gold. Hey, we did see it try and bounce out of that level, but they don't always get it out of that level. Sometimes the short-term trend is too strong, and we can see how price responds at the short-term trend zone, and we actually saw a break of the long-term trend zone, and that's key as well in terms of telling us we're transitioning from this uptrend phase potentially into a downtrend phase. And much like that copper chart, we talked about this idea of, well, where do we go? So if we see, again, some bearish candles in here, some black candles coming in, upper shadows, it would tell us that gold is in a lot of trouble. In fact, we're actually in sell the rally. We're actually in trend change from uptrend to downtrend, and we're going to go lower. If we get into this zone, we see a bunch of white candles, it tells us, you know what, we're just in a volatile stage, and we're probably not going down, but I wouldn't get too excited about going back up either, because there's a lot of supply in this area as well. But it would stave off the potential establishment of a long-term downtrend. Having a look at the energy markets down, I think this is one of the best charts out there, to be fair. We've seen this nice short-term uptrend, holding that dynamic support zone in the short term, holding the long-term dynamic support zone as well, and consolidating in sort of a nice pattern here with building demands, nice white candles beneath 116.6. I think if we can close above that, the oil price can go quite a bit higher, at least test those highs at 130.50. Having a look at the currencies, the Australian dollar did get a little bit of a bid side there, but as did most of the majors as the US dollar reversed. And that is important because strength in the US dollar is usually associated with risk off, because it is a flight to safety asset. So when we see the US dollar coming back, it's telling us that investors are prepared to take a little bit more risk out there in the market, and that is a positive thing. Now, the other positive thing for equities during the week was that long-term yields continued to come down. You can see the Australian 10-year bonds down 14 basis points and the US 10-year notes down about the same. Having a look at the yields of Australian 10-year bonds, we can see they're still highly elevated, of course, but coming down over the course of the week is welcome for Aussie equities. Of course, lower interest rates tend to help stocks. And in the US, we can see this developing head and shoulders pattern. So we talked about that inverted head and shoulders pattern on copper. We're seeing a traditional head and shoulders pattern here on US 10-year note yields. Of course, if yields are coming down, it means bonds are going up. Now, that's not necessarily great for stocks because bonds are often considered to be a risk-off alternative to risky stocks, but it does indicate that we are starting to see one of those major dislocations in markets over the last 12 months starting to dissipate. So where bonds and stocks are getting belted at the same time. So lower yields will help stocks. Bond market rally once it settles down. Some of that money will also flow back towards stocks, I'd say. So we're seeing finally some indication that probably a top in US 10-year yields are in. And let's have a look at some of those macroeconomic data impacting markets this week. We got the RBA May meeting minutes. So obviously they increased interest rates by 25 basis points in their meeting earlier this month, but the meeting minutes suggested that 40 basis points was on the agenda. They did back away from that, but noted that there are significant upside risks to inflation, and as a result, further rate rises are required. Also, that they are returning to normal operating conditions, and to be fair, none of these are really huge surprises for markets because we know they can't continue to maintain rates at those, COVID-induced emergency settings. Having a look at the Australian jobs data, we can see just how well the Australian economy is doing, and therefore probably doesn't need that crutch that the Reserve Bank has been providing. We did see 4,000 jobs created in the Australian jobs market over the course of April. However, if we look under the surface of that small gain, 92,000 full-time positions were created, around about 88,000 part-time positions were destroyed, hence the net 4,000 gain. But what it indicates is that Australian employers are increasingly having to put those part-time workers, that flexibility that they had, needing to engage those workers in full-time employment. So it is actually showing a very, very strong jobs market. The unemployment rate falling to 3.9%. Now that's the lowest it's been since 1974. And the participation rate fell very slightly. Usually a sign that workers are becoming disillusioned. I'm not so sure this time around. That's probably more of an aberration. I think you focus more on this and that we do have a very strong jobs market here. Hours worked rose as well, part of that switch to full-time work, and just noting the percentage of part-time workers now down to 30%, which is pre-COVID levels. Not going to spend too long explaining these next four, just want to show you the pictures that tell 1,000 words about the Chinese economy. So we can see downtrend here, last few readings on that fixed asset investment itself, very important in the Chinese economy. So coming in below expectations there, well down from the previous reading. Industrial production falling into the red, down nearly 3%. And then we have a look at retail sales, down 11%. And that was way worse than expected there, 6.1%. And you can see now 2 blips into the red. And we haven't seen anything as bad as that since the COVID crisis was upon us. And unemployment in China heading up. And of course, we saw all of those industrial metals rally during the week. That's kind of at odds with this data. And maybe it's giving us an idea that we're going to see some further stimulus from Beijing in the not too distant future. Let's have a look at the US economy now. We are seeing a bit of a moderation also in retail sales. We are also seeing a little bit of a moderation potentially in the US housing market, with permits and starts starting to flatten out. But to be fair, that trend, I think, is pretty much intact. So a lot of talk out there about a collapse in the US housing market, not really bearing out in that particular chart. Probably the most important bit of macro side information we got last week was from Jerome Powell's speech, where he started to give us a little bit of colour around what he needs inflation to do before he starts pulling back on those interest rate increases. He needs to see it come down in a clear and convincing way. Otherwise, they're going to keep pushing. If they don't see it come down in that clear and convincing way, then they may actually move more aggressively. And that did spook markets. And that's why we saw some of those falls in US markets during the week. He did hedge his bets a little bit by saying that if inflation does come down, they could move at a slower pace, but they're going to continue to move. What really riled the markets, I would suggest, is this idea that he's not too fussed about how poorly markets are doing. The history of the Fed, or at least the recent history of the last, say, 20 years, is that when markets wobble, the Fed tends to ride to their rescue. And Jerome Powell here is saying, look, we're not really going to do it this time. We don't think they're doing so poorly. He's saying, yes, there has been some volatility, but so far he sees us getting through this fairly well. And his definition of fairly well is the NASDAQ is down about 31%, the Russell 2000 is down about 30%, and the S&P 500 is down about 20%. So he doesn't seem all that fussed about the ructions in US equities at this stage, and investors are kind of wondering, well, what do we have to do to get your attention and to help us out? Having a look at some of the valuations in the Australian market, we can see that we are still, I'd say, better than fair value. 15 is typically considered fair value, 20 is expensive, 10 is cheap. And the big crashes we've had through history, so 87, 2007, have come from when the market has been, to be fair, in that overvalued territory, so above 20, sort of 22s in some cases. So at 14, hard to see a crash coming from here. However, if we did see a crash, hypothetically speaking, and this came down to 10, or let's say at half to 7, we'd probably be seeing a fantastic buying opportunity. Right now, the numbers might suggest that there is a buying opportunity in energy at 7.6 one-year forward PE, certainly half of its pre-COVID levels and way down from its COVID peak. Materials still looking pretty cheap on the same basis, as well as is the property trust, and utilities also looking pretty cheap. If I had to call one expensive, I'd say technology is expensive, although it's way, way down from its ultra expensive 77.4 at the post-COVID peak. It is still higher than its pre-COVID levels. However, healthcare and discretionary probably also falling into that category of being on the expensive side. Having a look now at how the technical analysis trends are playing out in the Australian market, we can see that over a one-year period, about 2/3 of stocks are in downtrends. That's disturbing. If we bring it back to the shorter term trends, we can see some improvement here, popping up to sort of 45% of stocks in uptrends over 1 week. But after that, it's pretty terrible across the board. Certainly better than last week though, but way off where we need to be to indicate we're in a healthy bull market where participation is high, and that would be roughly 2/3 of stocks in uptrends. So plenty of work to do to repair some of that damage inflicted on Australian shares. And you can see the damage here in the sector trends. So the Australian sector long-term trend, I've gone with neutral, but only just. If we break below that 69.33 handle, then that would switch to down to match its short-term downtrend. Discretionary, still down. I still think it's too early to get in there based upon those trends, as is the case with gold and information technology, despite their respective gains last week. Healthcare is looking half decent, as you can see from the up, down there, short-term, long-term, CSL the main driver. But I think that sector is on the improve. Energy, I think, is still strong despite that short-term neutral. I think you can still look for investing options there. So Santos, Beach Petroleum and Worley would be my 3 picks in that sector. I'm pretty neutral on financials, I think, right now. But the standout is going to be the utility sector. Still looks fantastic. AGL Energy, APA and Origin, probably the 3 standout picks there. Having a look at the upcoming data for this week, fairly quiet week. We do have some PMIs coming out today and then retail sales towards the end of the week, but otherwise nothing too market moving there. Incidentally, on the election, I don't think we're going to see a huge result today, assuming Labor does get a majority in the House of Representatives, and I think most are expecting that to occur. What we don't want to see is the balance of power in the House of Reps being held by those independents. Otherwise, look, let's face it, Labor and Liberal, pretty centrist platforms that they ran on, and there was a lot of Me Too in terms of tax cuts and the likes that might actually have an impact on the economy in the near term. So I think a fairly muted response to that from markets today, and markets will be moving on some of those other macro factors we discussed. Having a look at some of those macro factors upcoming for this week, we can see we do have some important manufacturing data coming out for Europe on Tuesday, and then also the US shortly thereafter. Jerome Powell, another speech there, markets will be hanging off every word, no doubt, and then Christine Lagarde, Jerome Powell's European counterpart, will be speaking as well. Durable goods orders in the US, important. FOMC meeting minutes, very important. GDP markets will be watching that one pretty closely also. And then the big data, I think, for the week is going to be the core PCE price index, which is the Federal Reserve's preferred measure of inflation. And they do also watch very closely personal income and personal spending data as well. Well, that's it for me today. You can catch more of my analysis tomorrow. That is Tuesday at 1 p.m, where I'll be doing Ask the Experts, and you get to tune in and ask me questions about your portfolio live. Anything you like, from stocks, crypto, indices, commodities, and I'll give you a quick technical and fundamental analysis reader. Otherwise, head over to the website, check out our offering. ThinkMarkets has over 4,100 products you can trade on Aussie shares and CFDs. Of course, all those indices and commodities as well. 24/7 customer support, a fantastic app, and not to mention my analysis as well. If you're watching us on YouTube or any of the other socials, make sure you hit that subscribe button or the bell icon to stay notified, and smash the like button to let us know you love what we're doing, so we'll keep doing it. Apart from that, it has been a pleasure chatting with you today. All the best for your investing until we catch up again. Bye-bye for now.